Board of AMC stock approves 2 to 3 bonus shares. We're going to talk about, is this true? When could you expect to get your bonus shares, and potentially what this could do for AMC stock, granted, if it is true. So I think that's very exciting. I think a lot of people are very excited about this. I know TMI put out a video about this. I did not, in all transparency, watch that video, but a lot of people have been talking about this, so I definitely do want to address it. At the same time, I think there's a lot of other things we must address here in this video as well. Specifically, what is going on in Italy? This article came out 5 minutes ago, and it is titled, Surging Borrowing Costs Take Italy Close to the Danger Zone. And yes, they are talking about the bond markets across the world. It's not only just the American bonds that are going through the roof, now at 3.45%. It's also European bonds and essentially bonds across the globe that have been going up. This is putting a lot of pressure on governments, and potentially, specifically Italy, could just go bankrupt. And you could see another, 2014, 2015 situation where Greece essentially was on the brink of going bankrupt, and that definitely spooked markets across the world. So I think that is very exciting in the sense of the opportunity that could come out of that. Obviously, we do not wish anyone economic pain here on this channel. I hope we all do well. I hope everyone does well. That's the nature of, what we do here on YouTube, specifically here on this channel at least. But I think it could have some big implications, possibly for AMC stock as well as the broad markets. Now, something that is catching everyone's attention is this, the Japanese yen. And look at this chart. I know it might be hard to see, kind of smaller to see on your guys' screens, but this is going parabolic. So essentially what this is $1 US equals 134.83 Japanese yen. This should not be happening. Essentially, the Japanese yen is losing its safe haven currency value, and that is a big red flag. Big red flag. So we need to talk about that. And you do also have this hedge fund that is shorting Japanese bonds until Bank of Japan break. So I want to talk about all of this information as well as really what to expect heading into tomorrow. We do have retail sales in the morning. We do have the summary of economic growth projections from the Fed, and we do have the Fed rate hike decision where the Fed is expected to raise rates by 3/4 of a point tomorrow. So let's get into all of this key information. If you guys find value out of this video, of course, hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. And just a fun fact for everyone out there, there is absolutely zero risk to reward, absolutely zero potential of making profits by not hitting the like button. Costs you nothing to do. Thank you guys for doing that, and get yourself those free stocks, like I said, down below in the description. And if you guys want to come trade with me live in real time, play the Powell, potentially the Powell put or the Powell calls coming tomorrow. I think there's a lot of opportunity there, and I think you guys would fit in well with the over 100 other traders we have in that group. So let's dive into this situation first with AMC stock and what is happening with the bonus shares. So let's go ahead and just read this. So it says, bonus shares. The board of directors of S Corp Asset Management Ltd has approved 2 to 3 bonus share issue. The approval came in the board meeting held on the 10th of June 2022. Apart from bonus shares, the AMC company board also approved an increase of share capital of the company and listing of company shares from BSE SME Exchange to main board of NSE Limited. S Corp Asset Management Ltd announced about the developments via Exchange Commission. Informing about approval of bonus shares by company board, S Corp Asset Management Ltd Exchange Communication says, and you guys get this, it goes on to say, like, talk about the stock market of India, all kinds of things. Now, here's TMI's video. Shout out to TMI. Thank you for bringing this to our attention. But unfortunately, this is not true. Unfortunately, it's not true. And I hate to be the bearer of bad news, but this is an AMC company that has no affiliation with AMC Entertainment. And you guys can see right here where they get AMC from. And I think they were trying to clickbait people by saying AMC, to be quite honest with you guys. But it says the shares of the company last close higher by 8% at RS 53 per share. S Corp AMC. This is another small cap services company offering blah, 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 blah. This is not for AMC. This is another company which has the name of AMC, S Corp Asset Management. So unfortunately, this is not true, but I have seen a lot of people talking about it, so I did want to address it here in this video, get straight to the point as fast as possible, and not really try to, lead you guys on or anything of those likes. And it was actually on the live stream last night. We had a lot of people that were talking about the bonus shares that were quite excited about that. Now, let's talk about this, because I think this is much more of an urgent matter, and I think this could be much more influential to potentially the hedge fund situation, as well as the overall just global market conditions. So surging borrowing costs take Italy close to the danger zone. Planned withdrawal of ECB stimulus intensifies debate over Rome's debt. Investors are questioning how far Italy's borrowing costs can rise before they rip a hole through the heavily indebted country's economy as a sell-off intensifies across Eurozone bond markets. Yields have shot higher in the bloc since the European Central Bank last week signaled an end to the stimulus measures it ramped up at the onset of the coronavirus pandemic. ECB President Christine Lagarde confirmed plans to withdraw a large-scale bond buying program and to initiate interest rate rises next month to tackle record levels of inflation. In turn, Italy has found itself in the market's crosshairs because of its need to refinance a borrowing load of around 150% of gross domestic product. Investors are dusting off calculations from the Eurozone debt crisis a decade ago as they try to understand when the rise in yields could start to imperil finances for the Italian government as well as for companies and households. Quote, "You can tell things are getting bad because people are starting to publish papers on Italian solvency again," said Mike Riddle, a bond fund manager at Allianz Global Investors. Quote, "The market isn't panicking yet, but all this focus on Italy is starting to feel a little bit like 2011, he added. Back then, worries over Italian debt sustainably pushed Italy's 10-year yield to a record high of more than 7%. It touched an 8-year high of 4.06% on Tuesday. The spread between Italian and German 10-year yields peaked at 5 percentage points at the height of the debt crisis a decade ago. Andrew Kenningham, an economist, oh my God, can I not read? At Capital Economics said he did not like the ECB would let it get that high, predicting it would intervene once it reached 3.5 percentage points. Now, what essentially is the problem here is that everything is connected. So the biggest thing I could see coming out of this Italian crisis, right, if Italy actually went bankrupt, one, it would just spook investors across the globe, but at the same time, it would make those yields go much higher in the bond market, which would have an effect and cause our yields in America, as well as other yields for European countries, to also go up in a very dramatic way. Now, this could be a big problem, not just for Italy, but for Europe as a whole, because Europe has had their interest rates at 0 since 2016. So it's much different than America. They have had low rates for a very long time. 2016 to 2022, you're looking at the last, 6 years, they have had 0% interest rates and this huge bond buying program. Now, if they're going to stop buying these bonds, they're essentially cushioning these European economies, that's going to drive rates through the roof. Now, if they're in question, going to go bankrupt, that's also going to drive rates through the roof. Kind of the same way that junk bonds work, right? If you're investing in junk bonds from a company that has a risk of going bankrupt, well, you're going to get paid a lot higher of a yield on those bonds, thus driving up essentially the rate of interest those economies have to pay, those countries have to pay, thus making it even closer or even more inevitable that they will go bankrupt. So I think this is a big problem. And then you could go into, the hedge funds that invest in Europe, things like that. And the spider web just becomes so large with that. We would have to make a whole video on that here on this channel. If you guys want a video like that, diving into, hedge funds, connections to different assets and who is more exposed than not, potentially who has AMC positions out of those hedge funds, let me know down below in the comment section. We could surely put that video together. but that's just too much to go over here in a 10-15 minute long video right here and right now. But that is obviously not a good thing for the overall world. Potentially could be a good thing for AMC, just given the connection that hedge funds have to Europe and what is happening in the bond market. When bond yields are going up in the way that they are, the bond prices are going down, and a lot of hedge funds use that 60-40 split, 60% stocks, 40% bonds. So when you're seeing the bond markets driving rates up, that actually means the bond prices are going down. So if you're a hedge fund that needs to put up collateral, that needs to put up the asset value or the face value of your bonds or your equities for a margin call, well, right now is not a very good time to do that, right? You can see bond yields have been going up. The bond prices have been just falling through the floor. Even something like the QQQ, which is the NASDAQ, up slightly on the day, but year to date down 31.37%. Now, if we pull up TLT, which is the ETF that tracks the 20-year treasury, what we just showed you guys on the chart, you can see that thing year to date is down almost 25%, down 24.60%. So there's a lot less capital to actually service those margin calls. If these bond rates continue to climb higher, maybe because of Italy, maybe because of just Europe in general, or obviously Fed Jerome Powell, that's going to put a lot of pressure on a lot of hedge funds in a very dramatic way, because not only are bonds getting destroyed if you're a bond investor, but also if you're invested in stocks, you're also getting destroyed with the NASDAQ down 31.5% year to date. Typically, that does not happen too often. Now, let's talk about the Japanese yen, because wow, look at this chart. It's pretty much been parabolic. Since January 15, 2021, one US dollar got you 103.79 Japanese yens. Now, you're at 134.83. So essentially what is happening is the yen is losing its safe haven currency value. So typically what happens when there's some level of financial crisis or something wrong going on in the world or the economy, people tend to go out and buy the yen because there's there's a lot of reasons for this. Japan tends to be a pretty neutral country. They tend to be pretty stable as far as economic activity. There's not really a lot of drops or pops. They tend to have low inflation because there's a lot of savings. Most people in Japan save a lot of money. I think the savings rate's like stupid high, like 50%, something ridiculous like that. So for a lot of reasons, a couple of those I just listed, the Japanese yen is seen as a safe haven currency. Well, when people start to actually sell off the yen, that starts to create more problems as far as potentially trade, right? If you're a company that does business in Japan, your exchange ratios are getting destroyed. So if you're like a Samsung, right, that makes products in Japan, potentially like a Sony, right, or Samsung, I believe, is that Japan? I know Sony is. Like if you make PlayStations and you're selling them globally and then converting that back to Japanese yens or converting that back to dollars, you're taking a substantial hit from this right now. And essentially the Bank of Japan will eventually come out and try to stabilize the currency just because what is going on, but they don't want to do that as of yet, and they might let this go a little bit longer. So we're breaking out of levels we have not seen in a very long time. If we continue to go higher, you're going to break out of levels we have not seen since 1998, and that was when one US dollar got you 139.68 Japanese yen. Before that, you have to go back to 1990, where one US dollar got you 158.94 Japanese yens, and then beyond that, it used to be a very high conversion rate. But other than that, we have not been at these levels in like decades, in a very, very long time. So this is really bad. And a lot of people are talking about this for just a lot of different reasons. This is not good. This is not good. When investors globally are selling off assets that should be seen as safe, like the Japanese yen, there's a big problem going on, and potentially this could signal we're going into a depression. This might not be a recession. This might be a damn depression. And I hope you guys are fully prepared for that because of the things we've talked about here in this video, because of what is going on across the world, and specifically in America with the federal funds rate being so low, heading into a recession, no way to accommodate the markets. You're in a really bad situation. And add on top of that inflation that's through the roof. You've never seen this before. In considering the Japanese yen, considering what's going on in Europe, what's happening in Russia, the food supply, what's going on in China, they're already probably in a recession as well. You're looking at a global depression right now. And I hate to be the bearer of bad news just across the board here in this video, but there's really not too much that is actually positive specifically about these multiple situations. But heading into the next couple of months, potentially next couple of years, it could be pretty bad. Now, what we have in store for tomorrow, retail sales 7:30 in the morning, like I said, and then you do have the interest rate decision, which is expected to be a 75 basis point hike, which the markets have started to price in over the last couple of trading days. Ever since about Friday, the market started to price in 75 basis points. We were not expecting that up until the CPI report. We were expecting a 0.5% rate hike. So we'll see if the Fed does that. Over the last 40, 50 years, they have always done what the markets have priced in. So it looks like they'll do that 75 basis point rate hike, and that's why essentially that there's no win for the markets or for the Fed. If the Fed does 75 basis point rate hikes, they might say, hey, the Fed's going to push us into a recession. They are killing all demand, and that's bad. If they say, hey, we're just going to do a 50 basis point rate hike, then the Fed is not getting aggressive enough on inflation, and that's another reason for the markets to essentially be fearful and to sell off more assets, right? To drop stock prices even more. Now, on top of that, we do get the summary of economic growth projections from the Fed, right? That comes out at 2 p.m. as well. It says 1 p.m., but I think this is Central Time, but it's really 2 p.m. Eastern Standard Time. And essentially what this is, I talked about this in the last video, but it's the Fed's GDP expectations for the year, its inflation expectations for the year, its unemployment expectations for the year, and a couple other things. But that GDP projection, I think, is going to be the most important thing. Inflation as well, but really the GDP, because the fears of a recession. Last time this came out in March, the Fed said they expected 2.8% GDP growth for 2022. Well, first quarter GDP came out and it was negative 1.5%. If the Fed comes out and they say anything that is like higher than 1% GDP growth, the markets are going to freak out. The markets are going to freak out. If the Fed comes out and says that, they still expect like 2% GDP, it's a wrap. It's a wrap. The markets are going to say the Fed has no clue what they're talking about. They're so disconnected from the real economy that you can't trust anything they say. So the Fed credibility would take a big hit off of that. At the same time, if the Fed is actually realistic and they come out and say, hey guys, we're not going to get a soft landing. We're essentially going to get a recession. We expect GDP to be plus or minus 0.5% for 2022. The markets are also going to freak out on that because it's the Fed admitting that we're going into recession, that things are not good. So there's really no win here. There's no win no matter which way you put it. The only way that you could see there being a win is, let's say the Fed comes out and says, yeah, we expect 0.5% to 1% GDP growth for 2022, which is acknowledging there's a problem, but potentially we could come out of it. The Fed saying, hey, we expect inflation to last a long time. We expect it to be very high, but we think we can get inflation down to like 7.5% by the end of the year. And then for 2023, we expect we can get inflation down to, let's say, 5%. And then 2024, we can get that down to 2%. The Fed being realistic could be seen as a very good thing. But still being negative overall. So acknowledging a problem, but saying, hey, there is an end solution to this. It's just not going to be anytime soon. And then granted, the markets are down so much with the QQQ down, like I said, about 31.5% for the year so far. That could be seen as, hey, maybe enough damage has been done. Maybe we could see a short-term rally, but I am not expecting that, and I don't think that is going to happen. I think it's very well possible that we could go back to levels that we were at right before COVID. And these are really my predictions and my levels that I'm targeting on the QQQ, and that's again the ETF that tracks the Nasdaq, that would be about 235, which would be about another roughly 15% drop from here. You're talking about the Nasdaq potentially being down 46-47% year to date if we do get something from the Fed that the markets do not like. And same thing on the S&P 500. I think the bottom pretty much is going to be the pre-COVID levels, and I think this could be a multi-decade long bottom. I really don't think we're ever going back to these prices again in the future. And for the S&P to get back to pre-COVID levels would be a drop of about 12% from here. That's what could happen coming over the next coming weeks in the next coming months, essentially. So that's it. That's really what you guys need to know. We're going to go over some more of this information, some more things you guys need to know. The video coming out at 4 p.m. But I really wanted to get this video out because Italy, bad situation. The Japanese yen, bad situation. What is going on in the bond markets with bond yield? Also a very bad situation. But it could add a lot of pressure to hedge funds. So in a way, it's bad for the overall markets, but potentially could be good for AMC stock, for short squeeze candidates. So that is going to be all for this video, as well as the bonus share situation. I don't know if people actually still believe that is the case, but it's absolutely not for AMC stock. And I think that's very important to also point out here in this video. So thank you guys for watching. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Get your free stock with Webull, Moomoo, and Public down below in the description. It has never been a better time to get yourself some free money. Deposit $100 with Moomoo and Webull. You will get up to 10 free stocks with Webull, as well as get up to 4 free stocks with Moomoo. Both of those platforms, I love them. I use them. That's what I've been actively using to trade in and out of positions, which we have been doing a lot of, potentially, hedging even more for the downside than we already are right now. But that's what we have been doing over the last couple of days, and we've been getting paid out very, very nicely for those. So if you guys want access to all of that, come join a group of over 100 traders. Link down below in the pinned comment. Thank you guys for watching, and I will see you in the next one.